Well guys, would you look at that? We just got yet another inflation report showing us that inflationary pressures are indeed easing. The highly sought after PPI index, which is called the producer price index, just came in lower than analyst estimates for not only core but also broad. And this is sending the stock market into a turmoil after hitting a fresh new high for the past 3 months. So with inflationary pressures now clearly easing and the stock market realizing the potential of the next bull market, what do we have in store for the Fed in the December meeting? And are we actually headed into a deeper recession than we initially thought in the first half of 2023? Well, that question is exactly what I want to address in this video. But as usual guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, let's look at the trend of the PPI index, which just came in at its lowest month-over-month level since November of 2020. This is very important, guys, because back in November of 2020 is when inflationary pressures really started taking off because of stimulus checks, lockdowns, and obviously high consumer spending. And the really amazing part here is that not only is CPI and PPI both coming down, but their core components, excluding food and energy, have also collapsed. And by far the most impressive thing about this PPI report is the fact that services inflation has indeed inflected to the downside, and it is putting in its first negative reading in over 12 months. Now, the reason why this is such a big deal is because services inflation has been the main reason why CPI has been so elevated for the past 12 months. Obviously, also excluding energy, which has obviously been in a turmoil since the start of the Russian war. And services inflation always tends to be much more sticky than goods inflation, which is why the Fed had to be more aggressive as people kept spending money on their credit cards on these services that they were so addicted to since the pandemic. And now for the first time in over 6 months, core PPI has come in at 0% month over month. And like I've already said countless times, month over month data is what we actually want to pay attention to, not year over year. Because month over month data leads the year over year number. So even if the year over year number is very high and way above the Fed's actual target of 2%, the Fed is going to look at the month over month data to try to time what's going to happen with the year over year data so that they don't do excessive damage to the economy. And it's that damage paired with the fact that inflation expectations did rebound a little bit in October on record high jump in gas prices that is concerning most investors going into 2023. Because even though shorter term inflation data is showing us that pressures are easing, we have seen this story in the past where inflation starts coming down but then also can start going up. But the really important thing that those kinds of investors are forgetting is the fact that the Fed is again looking at leading data going forward after this month's meeting. Now, they clearly said they're not going to back off this inflation fight, but that does not mean that's a bad thing for the stock market, because not only is the stock market forward looking by around 6 months, we're already starting to see the Fed's job at work, meaning we're going to see potentially slower rate hikes going into the end of the year and a lower terminal Fed funds rate. And when you have the chance of a US recession probability at over 96%, the highest since 2008, then you have a very good shot at bringing down this inflation, because this means consumers are going to start cutting spending. And as this tech industry has laid off so many people, people are simply going to have less money to spend on their checking and savings accounts. And so the reality is, in the stock market, you can spend anything to be in your favor of your narrative, but you need to pay attention to what the stock market actually cares about. And clearly, over the past 14 to 18 months, the stock market cares about one thing, and that is inflation data. And so you can bet your bottom dollar that the stock market is going to look at the leading indicators of that inflation data and forget about anything else. It doesn't matter if we're going to go into a recession in 2023. Many people already know that. Most investors are aware of that situation because it's been in the headlines since the start of this year. Instead, what most people are not discussing is the trend of inflation on a core level and the fact that month-over-month data is already starting to see weakness. Just like in 1981, we could see a similar situation today where the stock market bottomed before the Fed chair actually pivoted. And with bond yields at the highest level since the great financial crisis and lending standards so tight, you are bound to see real estate, car prices all start coming down, which again is a leading inflation indicator. And so yes, as an investor, it's been a painful past 12 months. And if you've bought companies or stocks that you no longer have conviction in, then chances are you are a part of this asset bubble either in ARKK, the FANG Plus, or Bitcoin, and you might need to sell your position. But if you're buying businesses that you know are high quality, that you can hold your conviction in regardless of what the broader stock market does for the next couple of years, then right now is the best time to buy. Even Michael Burry has been adding positions over the past few weeks in his own high conviction companies. And this is a sign that overall institutions are still bullish on this market and they're taking advantage of the dips they're seeing. And that is obviously a big contrast to how most institutions are playing their game on social media, where they're trying to predict how the market's going to continue to go down or the fact that the recession in 2023 is going to be big. And obviously the simple reason they do that is because they want to sound right on social media and not sound crazy to the average investor. Because obviously all the average investor has seen over the past 12 months is red and red. So if there's anything they hear apart from that, they probably think you're crazy. And that is exactly why all these bull market rallies throw most investors in disbelief. And when you see that kind of delusion in the market, that's when you know we are near that bottom. And as for the folks that are waiting for the earnings recession to be over and for inflation to come down to 2% before buying stocks, keep in mind that the stock market has historically always bottomed well before a recession is over, and sometimes even before we know that we're in a recession. And right now, although we saw the first and second quarter GDP declines, we have not officially called 2022 a recession, meaning we're in that range that the stock market could bottom. And guess what? Playing the macroeconomics as an investor in the short term does not make you any better than anybody else, because the macroeconomic data is available to everybody in the stock market. Instead, it's important to realize that the stock market is not the economy and that you want to play with a contrarian perspective. But obviously, guys, that is just my take on the situation, so let me know your thoughts down in the comment section below.